Welcome to Iron Financial, where we forge stronger portfolios by cutting through market weakness. Today, we're tackling a real head-scratcher, a paradox that has Wall Street buzzing, a situation that really tests the very foundation of how we evaluate a company's health and its future. Right, it's the kind of thing that makes you question everything. You've got a company that, on paper, looks like it is absolutely firing on all cylinders. They come out and report what looks like a rock-solid quarter, and then, boom, the stock gets absolutely hammered, hitting a 52-week low. So is this just a glitch in the matrix, or is there something more sinister lurking just under the surface? That's exactly the question we're here to figure out. The company caught in the middle of this storm is EPAM Systems. Now, these guys are a major player in the digital transformation space, and they just reported what, by all accounts, should have been a stellar quarter, a reason for celebration. But the market's reaction was nothing short of brutal. And this is precisely the kind of disconnect that can either make or completely break a portfolio. So what's our plan of attack? How are we going to figure out if this company's foundation is built on solid rock or just shifting sand? Well, we're going to do what we do best here at Iron Financial, a deep structural dive. We're going to examine every single number. We're going to scrutinize every comment from management, and we're going to dissect every piece of guidance to truly understand what spooked the market and sent investors running for the exits.
Okay, let's just lay out the facts side by side, because the contrast is really something else. On one hand, you have the press release, and it is just glowing. We're talking strong double-digit growth in both revenue, up almost 13%, and their non-GAAP earnings per share, up nearly 15%. Plus, they're showing significant momentum in literally the hottest sector on the planet, artificial intelligence. But then you look over at the market's reaction, and it's a complete bloodbath, a gut-wrenching 21.6% plunge in the stock price. It set a new 52-week low, and the trading volume? It was screaming one thing: get me out of this stock now. This is the kind of wild disconnect that keeps us up at night.
Okay, so here's our blueprint, our game plan for today. First, we are going to build the bull case for EPAM. We'll look at all the good news, the steel beams and the reinforced concrete of their quarterly report. Then, and this is the important part, we're going to put on our hard hats and start inspecting for any structural weaknesses. We are looking for those tiny hairline fractures that could compromise the entire structure. And finally, we'll put it all together and render a verdict. Is this a massive buying opportunity, or is it a trap waiting to be sprung?
All right, let's get into the nitty-gritty. Before we can even begin to understand why the stock completely imploded, we absolutely need to understand the strength of the bull case. And let me tell you, on the surface, Q4 of 2025 looked like a fortress of positive results. The bull case is really straightforward, and it's compelling, and it all starts right at the top line with revenue.
First up, let's talk about that top line. Revenue came in at over $1.4 billion. That's a nearly 13% increase year over year. And in this kind of economic environment, that is a very healthy growth rate. But what's maybe even more impressive is that they beat their own guidance. And that's the key here. When a company tells you what they're going to do, and then they proceed to do even better, that's a powerful signal. It speaks volumes about their strong execution and solid operational control. And, it's not just about the top line. Profitability is looking really strong as well. Their non-GAAP earnings per share, which, remember, gives us a clear picture by stripping out some of that accounting noise, was up almost 15% year over year, coming in hot at $3.26. So they're not just growing, they're growing profitably. This isn't one of those growth at all cost stories. No, this is disciplined, profitable expansion that's flowing directly to the bottom line. So I have to ask again, what's not to like here? Okay, so the top line growth is obviously impressive. But where is that growth actually coming from? Is it all concentrated in one area, or is it more broad-based? That's a great question, and this slide gives us the answer we need. This company is not a one-trick pony. The foundation of their growth is incredibly broad-based. Look at this. 5 out of their 6 industry verticals grew. Financial services and software and high-tech were really doing the heavy lifting, both with nearly 20% growth. This demonstrates a serious level of resilience. If one sector takes a hit, they have others to pick up the slack. This is the hallmark of a well-constructed and durable business model. Okay, let's talk about the elephant in the room, artificial intelligence, AI. Every single company is talking about it. Every CEO is dropping the acronym in their earnings call like it's some kind of magic password to unlock shareholder value. So, is this just hype, or is it real for a company like EPAM? Are they actually building something substantial with it, or are they just slapping a fresh coat of AI paint on their old services to impress Wall Street? That's the million-dollar question, isn't it? Let's take a much closer look and see if we can separate the signal from all that noise. And this is where the story gets really, really interesting. This isn't just them talking. They're putting hard numbers on the table. In the fourth quarter alone, they booked over $105 million in what they specifically define as pure AI native revenue. Wow. Okay, so that is not just a rounding error. That is a significant chunk of change. And what are they projecting for the future? Well, that's where it gets massive. Their projection for 2026 is to scale beyond $600 million. This isn't some side project or a little experiment. This is being forged into a core pillar of the entire business, a brand new engine designed to drive this company forward for the next decade.
And just listen to how their CEO, Balazs Fejes, is framing this whole thing. He says, quote, "We believe we are entering an age of building." An age of building. I mean, that's some pretty lofty rhetoric. What exactly does he mean by that? Is he just trying to sound like some kind of visionary, or is there real substance behind that soundbite? Well, he's making a very specific point. He's not just saying they use AI tools. He is framing EPAM as a foundational builder in this new AI economy. They are positioning themselves as the architects and the engineers who will construct the AI-native platforms of the future. That's the story they're selling, and I have to admit, it's a powerful one.
Okay, so they're definitely talking a big game, but is anyone else buying it? Are there any external validations of their expertise, or is this all just internal hype? That is the crucial question, and the answer is a resounding yes. The industry's biggest players are lining up to validate their expertise. Being named Partner of the Year by both Microsoft and AWS is like getting the highest possible seal of approval from the two titans of cloud computing. And it's not just the big tech companies, right? They've also got these leader designations from top-tier analyst firms like Gartner and Forrester, which adds a very thick layer of concrete credibility to their claims. This isn't just EPAM saying they're good at AI. This is the entire industry ecosystem saying that EPAM is at the absolute forefront of building this new world. Okay, so let's just recap for a second. We've got a company with a rock-solid quarter, impressive diversification across multiple industries, and a massive validated opportunity in AI. The structure looks solid as a rock. So why the 20% demolition? Why did the market bring a wrecking ball to what looks like a perfectly good building? That's the question we're here to answer. It's time to put on our safety glasses and start looking for those hairline cracks, the subtle details buried deep in the fine print of the blueprints. Okay, so before we dive into the potential problems, there's a term I've seen pop up in the report that I think we absolutely need to define: organic constant currency growth. What exactly does that mean, and why is it so important for us to understand? That's a key concept. The market is just full of financial noise. Reported growth can easily be inflated by things like acquisitions or favorable currency movements, so sophisticated investors, the smart money, they look past all of that to organic constant currency growth. This metric strips away the financial engineering and the currency tricks to show you one thing and one thing only: how the core underlying business is truly performing. It's the purest stress test of a company's health you can find. And this is exactly where we find the first crack. It's subtle, but believe me, it is significant. Buried deep in the CFO's comments on the earnings call, you find this little nugget: a problem with a single large client from their Neoris acquisition. A single client? How big of a problem are we really talking about here? Well, it's substantial. So substantial, in fact, that it's projected to drag down the entire company's organic growth rate by a full percentage point next year. A full percentage point from just one client? For a market that is obsessed with growth, any headwind is a concern. But a 1% drag from a single source, that is a notable weakness in the foundation. Here's another subtle but really important detail: the consultant utilization rate. You can think of this as the heartbeat of a consulting firm. It measures the percentage of their highly paid consultants who are actively billing clients versus those sitting on the bench. And that heartbeat just slowed down, dipping from 76.2% down to 75.4%. Okay, so management is trying to explain it away with things like more vacation time and hiring junior staff who take longer to ramp up. But is that the whole story? Or is this a sign of something more concerning? To a seasoned analyst, any dip in efficiency, no matter how small, is a potential stress point. It suggests that they have more supply of talent than immediate demand, and that's a red flag. And we are not done yet. Here are two more fissures appearing in the structure. First, their gross margins are getting squeezed by higher pay, so it's costing them more to deliver their services, which of course puts pressure on their overall profitability. That is a classic warning sign. And second, and perhaps even more importantly, the CEO himself admits that the big, exciting AI deals are taking longer to close. He calls it a modest extension, but for a market that is absolutely obsessed with speed and frictionless growth, any mention of a slowdown, however modest, is a major red flag. It hints that the path to that $600 million in AI revenue might just be a little steeper and more treacherous than they're letting on. So let's just take a step back for a moment. We've found a few cracks in the foundation, a significant client problem, a dip in utilization, some margin pressure, and a slower sales cycle for their all-important AI business. But are these just cosmetic issues, things that can be easily patched over? Or are they signs of a deeper, more structural problem? The answer, as it always is, lies in the guidance. The market doesn't invest in the past, it invests in the future. Yesterday's strong quarter is already ancient history on Wall Street.
And this slide right here tells the entire story. I want you to forget the top line reported revenue growth. Frankly, that's just noise. I want you to focus your attention on that organic constant currency growth line. In 2025, they delivered 4.9%. That was the true measure of their core performance. Okay, 4.9%. That's a solid number. But what are they guiding for in 2026? Well, that's where the story turns. The midpoint of their guidance for 2026 is 4.5%. Even with their booming AI business that's set to bring in over $500 million, their core growth is guided to decelerate. And that's the whole game right there, isn't it? It doesn't matter that 4.5% is still growth. It doesn't matter that their earnings per share is guided to go up. The market is a machine that runs on acceleration, not just speed. Exactly. It saw the rate of growth slowing down. It connected that dot to all the cracks we just found, the Neoris client, the utilization dip, the slower sales cycle, and it hit the big red sell button. The future looked just a little bit weaker than the past, and that was all it took.
So let's put all the pieces of this puzzle together and render our verdict. We've examined the solid structure of their Q4 report, and we've meticulously inspected the cracks revealed in their forward-looking commentary. So what's the big takeaway for an investor looking at EPAM today, with the stock sitting in a massive crater? The crucial point for everyone to understand is this. The sell-off had absolutely nothing to do with their strong Q4 performance. It was a forward-looking verdict on the potential for slower growth ahead. The market is a discounting mechanism. It looks at all the available information and prices it in immediately. So it priced in the risk from that Neoris client headwind. It priced in the margin pressure from higher compensation. And it priced in the uncertainty of a slower sales cycle for their all-important AI business. Exactly. That 21% drop was the market's swift and absolutely brutal assessment of those future risks. Which leaves us with the final and most important question for any potential investor out there. Is this 21% plunge an emotional overreaction to a handful of manageable minor issues? Is this creating a massive buying opportunity in a company that is still a validated long-term leader in the AI revolution? Or is this a rational early warning sign? Is the market correctly signaling that the period of easy, high-speed growth is over and that the path ahead will be slower and more challenging than the bulls want to believe? That is the dilemma. And the answer to that question determines whether this is a foundation you can build on or a structure you should avoid. And understanding both sides of that argument, the impressive performance and the subtle risks, is how you build a portfolio of iron. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.